Vanakkam. Welcome to this video on Introduction to Accounting Standards. In this video, we will be covering accounting standards issued by ICAI, notified under the Companies Act, in the context of the Income Tax Act, International Financial Reporting Standards, and then Indian Accounting Standards. Before we get into accounting standards, let's just look at the basics. At the bottom of the hierarchy, we have transactions and events, the day-to-day operations of a company like purchases, sales, payment of wages, and so on. The economic aspect of transactions and events are captured in books of accounts, your day books, your ledgers, and so on, and these are summarized as financial statements. Now, what is the purpose of financial statements? ICAI has given a beautiful statement in the new study material for CA Final, which says financial statements should reflect the underlying economics of transactions and events in a transparent and unbiased manner. So, this statement in fact captures the essence of financial reporting. This is what is our ultimate aim. So, a person looking at the financial statements will obviously not have time to go through the entire books of accounts in order to understand what is happening in the company. So, it is our job as chartered accountants to make sure that the financial statements give a clear picture of the transactions and events, so that the users of these financial statements can grasp the profit or loss of the company and also the financial position of the company. So, let us proceed. What are the issues that accounting standards deal with? Now, we saw what are financial statements. Now, what is the link between financial statements and accounting standards? So, accounting standards deal with recognition, measurement, presentation, and disclosure. So, what is recognition? Recognition means recognizing, the act of recognizing the economic impact of transactions and events. So, basically, when should we pass a journal entry in simple words? So, debtor to sales, we are recognizing revenue. Purchases to creditors, so we are recognizing the purchase. So, recognition is basically when we should pass the journal entry. Measurement, what is the amount at which we should pass the journal? Now, suppose you are selling goods worth 100 rupees, you are giving a trade discount of 10 rupees. So, will you pass the entry debtor to sales at 90 or 100? So, will you measure the sales net of the trade discount, or will you measure the sales as the gross amount? So, that is measurement. Presentation, how do you present in the financial statements? So, if you have created a provision for doubtful debts, will you show that provision on the liability side, or will you reduce it from the debtors on the asset side? So, that is presentation. Disclosure, the disclosure is basically the explanations that we give in the notes to accounts below the financial statements to help the user understand. So, some aspects may not be clear, what accounting policy we have followed. So, these are all typical disclosures that we give. So, the aim of accounting standards is to help what? To help the financial statements give a clear picture of the underlying economics of transactions and events. So, now we see how accounting standards help financial statements accomplish their purpose. And in order to accomplish that purpose, four broad issues that accounting standards deal with is what we just saw: recognition, measurement, presentation and disclosure. So now that we have understand the basics of accounting hierarchy, the purpose of financial statements, and what are the issues that accounting standards deal with and how they help financial statements accomplish their purpose, let us get into accounting standards in a little bit more detail. So how are accounting standards framed? So we have Institute of Chartered Accountants of India, which has the council, which is the main governing body, and under that there are many committees like standing committees, non-standing committees, and the accounting standard board comes under a non-standing committee. You also have board of studies and other non-standing committees. Apart from that, you have the directorate of ICAI and you have other departments. So this is insofar as ICAI is concerned. For companies, we have something called the National Financial Reporting Authority. This National Financial Reporting Authority recommends the accounting standards to be followed for companies, and then the central government through the Ministry of Corporate Affairs issues the accounting standards for companies. So what is the process of framing and issuing an accounting standard? So now that we have seen the different departments of ICAI, we will be focusing on the accounting standard board because that is what is in our purview. So what this accounting standards board does is, it first identifies areas and constitutes study groups. So what areas require standardization, that is identified. So previously, so you may have studied in school that you have different methods of inventory valuation: simple average, weighted average, moving simple average and so on, last in first out, first in first out. So you imagine a situation where different companies follow different methods for inventory valuation. Suppose there are like 10 methods, and each company follows its own method, and for raw material it follows one method, for work in progress it follows another method. So if that is the case, then it becomes very difficult to compare the performance of two companies because inventory significantly impacts the profit or loss position. So in a situation like this, the accounting standards board will say, okay, currently the inventory valuation system is not standardized, let us standardize it, let us try and frame an accounting standard. So I am talking about the pre-accounting standard 2 era, before all these accounting standards were issued. This is what the accounting standards board would have done. Now also if some new situations arise which require standardization, this is what the accounting standards board will do, right? So first it identifies areas and constitutes study groups. Then a preliminary draft is prepared, preliminary draft of the accounting standard. This is circulated to a few select bodies like SEBI, MCA and so on. Then an exposure draft is prepared. So this exposure draft, after receiving comments from the select bodies, this draft is circulated in the public domain. Even you and I can give our opinion that this particular provision needs review and so on. Then a final draft is prepared, sent to the council, and the council issues the accounting standard for non-corporates. In the case of corporates, there is one additional step. The Council of ICAI will not issue the standard directly but will send it to NFRA. And NFRA will recommend the standard and MCA will issue the standard. So essentially we have an accounting standard board. It initiates the process, it prepares drafts which are circulated to few select bodies first, their comments are received, then exposure draft, public comments, and then the accounting standard is released, or it is sent to NFRA, which advises the central government, and the central government issues the standard through MCA. So, this is basically how accounting standards are framed. Now, it is all fine to frame accounting standards, but how to implement it? Who has to mandatorily follow it? So, that is what we are going to see now. So, insofar as sole proprietary concerns are concerned, there is no law in India which governs proprietary concerns. So, ICAI may say that for non-corporates also these accounting standards should be followed, but there is no way to enforce it currently for proprietary concerns. Similar is the case for partnership concerns, right? So, for partnerships also it is not mandated by the Indian Partnership Act. If you take trusts, now for trusts there is the Indian Trust Act or Societies Registration Act does not say that you have to follow accounting standards, but it is indirectly enforced through the tax audit report which trusts are required to give. There the auditor is required to state whether applicable accounting standards have been followed. For mutual fund schemes which are also governed or rather owned by mutual fund trusts are also registered under the Indian Trusts Act. As per SEBI guidelines, mutual fund schemes are supposed to follow accounting standards. Now they have to follow Indian accounting standards, right? So, for proprietary concerns, there is no statute in place. So, currently we cannot enforce implementation for proprietary concerns or for partnership concerns, but for trusts we can enforce it. For trusts other than mutual fund trusts, it can be indirectly enforced through the tax audit report, and for mutual fund trusts they have to follow Indian accounting standards for mutual fund schemes, right? Now, next, coming to companies. So, this we all know, section 133 of the Companies Act requires companies to follow the applicable accounting standards. So, for proprietary and partnership concerns, it is not mandatorily applicable as per law, even though ICAI says that they have to follow. For trusts, it can be enforced indirectly for other trusts and directly by SEBI guidelines for mutual fund trusts. Companies definitely have to follow accounting standards. Next, let us look at the applicability of accounting standards. There is a 3-tier applicability system put in place by ICAI. First is the enterprise level. ICAI says that all enterprises should follow accounting standards except 100% not-for-profit enterprises. So, for example, there is a trust. It collects donations and spends for the welfare of the poor and elderly, does not retain any surplus. So, that would be an example of 100% not-for-profit. But if there is a trust which is trying to promote, say, yoga, and it's selling some publications, it's selling some yoga books, so that cannot be called 100% not-for-profit. So, according to ICAI, that trust which sells books, and even though there is a small profit element, that trust has to follow accounting standards. But if there is no profit element at all, then that trust need not follow. So, applicability is not based on whether you are proprietary concern, partnership, company or trust. Rather, applicability is from the point of view of whether you are 100% not for profit or not. That is what ICAI says. But of course, there are loopholes because the law has to ultimately make it mandatory. Otherwise, it is difficult to enforce, right? That is what we saw earlier. Next is the financial statement level applicability. So, accounting standards are intended to be applied only to general purpose financial statement. So, if you are submitting a loan application to a bank with a projected income and balance sheet, then you do not need to follow accounting standards for that, because that is not a general purpose financial statement. That is a specific purpose financial statement. General purpose financial statement is something which is used by all, that is your investors, creditors, bankers, any person who has an interest in the company will look at that statement. And what are they? So, they are balance sheet, P&L and cash flow statement. So accounting standards should be applied only to general purpose financial statements, right? Then the last point, financial item. Accounting standards are intended to be applied only to material items. So now you have studied in auditing what is a material item, something that is likely to influence the decision of the user, right? Now if you have a company that is making turnover in hundreds of crores, so let's say it has an item of inventory worth 1 lakh. The cost of that inventory is 1 lakh, net realizable value is say 99,900. So whether you value at 1 lakh or 99,900, the lower, is it going to affect the decision of the user if that company has turnover in hundreds of crores? That is not really going to impact the profit. So that is not a material item. So even if the company had not valued at 99,900 and instead had shown the stock at 1 lakh, it would still not be considered a violation, right? So materiality should be judged from the point of view of the decision of the user, okay? Of course, there may be several such items and the aggregate impact may be material. So all that also you have to consider. So in simple words, accounting standard should be applied only to material items. So as per ICAI, there is a 3-tier applicability system: enterprise level, financial statement level and financial item level. The other aspect is the legal aspect. So to which entities accounting standards can be legally enforced. We saw in the case of some trusts and also for the case of companies, right? So if an enterprise is profit making or partly profit making, it has to follow accounting standards. But does it need to follow all accounting standards? Does it have any exemptions available? That is what we are going to see next. So for the purpose of giving exemptions and relaxations, entities are classified into different levels. This classification is different for non-corporates and corporates. For non-corporates there are 4 levels and for corporates there are 2 levels. The levels for non-corporates are level 1, 2, 3 and 4. Level 1 being entities which need to follow all accounting standards. Entities falling in level 2, 3 or 4 will be entitled to certain relaxations and exemptions. Corporate entities are classified into SMC and Non-SMC. SMC is small and medium company. SMCs have more exemptions and relaxations, non-SMCs do not. Now let us study the criteria to be satisfied to get included in levels 1, 2, 3 or 4 or under SMC and non-SMC. So for non-corporate entities, as we just saw, we have level 1, 2, 3 and 4. Level 1 entities are those that are listed or are in the process of listing. So either its equity or debt securities may be listed or may be in the process of listing on a stock exchange in or outside India, or the entity is a bank or a financial institution or an insurance entity, or the entity has turnover excluding other income greater than 250 crores in the immediately preceding previous year. So what does this mean? So suppose we are discussing the year 31/3/2025 and for the year 31/3/2024 this entity had a turnover of 251 crores. So for 31/3/2024, if it satisfied this criteria, then for the year 31/3/25 it will be classified as a level 1 entity, right? This turnover should exclude other income. So in your schedule 3, you have revenue from operations, other income, right? So that other income should be excluded while calculating this 250 crores. Next, if its borrowing including public deposits was greater than 50 crores at any time during the immediately preceding previous year. So continuing the same example, as on 31/3/2024, let's say it has a borrowing of 40 crores. We won't immediately say it is not a level 1 entity, because for level 1 entity borrowing should be greater than 50 crores. 31/3/24 borrowing is 40 crores. So it's not a level 1 entity. No. That borrowing, the balance of the loan account and other debts, if it exceeded 50 crores at any time during the immediately preceding previous year. So we have to analyze all the 365 days of the year ended 31/3/24. Any day if the borrowing balance was more than 50 crores, then for the year 31/3/25, it will be a level 1 entity. Okay. So for borrowing, it is any time during the immediately preceding previous year. And this borrowing should include public deposits. Remember, for turnover there is an exclusion, for borrowing there is an inclusion. A simple way to remember these values, just remember 250 and then go on dividing by 5. So 250 by 5 is 50. Same way for level 2, it will be 50 and 10. Then for level 3, it will be 10 and 2. Okay, so that's a simple way to remember. Just remember 250 and go on dividing by 5. Okay, so borrowing greater than 50 crores anytime during the immediately preceding previous year, or if it is a holding or subsidiary entity of any of the above entities. So let's say entity A is a bank. Entity B does not satisfy any of these conditions, but entity B is a subsidiary of the bank. Still, entity B will be a level 1 entity. Okay. So that entity itself may not satisfy the first 4 criteria, but its holding or subsidiary, if it satisfies, then the entity will become a level 1 entity. Now, when we are talking of holding and subsidiary companies, you may suddenly have a doubt, why are we having all these conditions for non-corporates? In India, can non-corporates be listed on a stock exchange? Or can non-corporates have holding and subsidiaries? So you must understand that the history behind this. So initially, there was only one set of accounting standards and that was applicable to all. Later, there were some changes in the Companies Act. So there was a separate classification for non-corporates and corporates. That is one. The other point is, sometimes there will be some redundancies in law. In other words, we try to make that law future proof also. Okay. Suppose in future, partnerships are allowed to be listed on a stock exchange. Then you don't have to amend this again and again. Okay. So that is the reason why these criteria have been retained. Even though in the Indian context, non-corporates cannot be listed, they cannot have holding subsidiary, but still those criteria have been retained. Okay. So what are level 1 entities? Either they are listed, or they are banks, financial institutions, or insurance entities, or turnover excluding other income greater than 250 crores. Remember, it is greater, not greater than equal to. Okay. Greater than 250 crores in the immediately preceding previous year. Borrowing including public deposits greater than 50 crores. Just divide by 5. Any time during the immediately preceding previous year. Holding a subsidiary of any of the above. So you just need to be thorough with the level 1 criteria. For the others, it is just slight modifications. For level 2, 3 and 4, just forget these first 2 criteria. Focus on 3rd, 4th and 5th. We will just slightly modify the limits. Okay. So now let's look at level 2 criteria. So level 2, also referred to as MSME, micro, small and medium enterprise. Turnover excluding other income. So what did we discuss? Remember, just 250 divided by 5. So greater than 50, less than or equal to 250. Next, the same condition, borrowing, divide this by 5, 50 by 5. So greater than 10, less than or equal to 50. The last is the same, holding subsidiary of any of the above. So how to remember the limits? Just remember, for level 1 it is greater than 250. So for level 2 it will be greater than 1/5 of this 50, less than or equal to 250. So that is logical. So we are just moving below. So for borrowing for level 2 it will be greater than 10, less than or equal to 50, holding a subsidiary. Now there is a new term here, MSME. So this clarification was given by ICAI because there is a separate act for MSME, and micro, small and medium enterprise need not be a company. Okay, it can be a partnership firm. It may have a turnover of greater than 50 crores, or it may have a borrowing greater than 10 crores any time during the previous year. So such enterprises will be level 2. The MSME abbreviation has been added recently by ICAI just to indicate that such enterprises also will have to follow accounting standards. Of course, they are non-corporate entities, but still they will have to follow. It's like ICAI trying to remind certain entities, look, just because you are MSME, you are not exempt. But as we discussed, ICAI can of course take various steps to encourage implementation of accounting standards, but unless the law mandates it, practically it becomes difficult to enforce. We discussed that earlier. So that was level 2. Now similarly we are going to see level 3 criteria. So level 3, turnover excluding other income greater than 10 crore, less than or equal to 50. So borrowing, what will it be? Including public deposits greater than 2 crore, just divided by 5, less than or equal to 10 crores, holding or subsidiary. And level 4 will be neither level 1, level 2 nor level 3. So that means if it is not listed, okay, not bank, financial institution, turnover should be less than or equal to 10 crore, borrowing less than or equal to 2 crore, and it is not holding a subsidiary of any of the level 1, 2 or 3 entities. So level 4 is basically the smallest kind of entities. They will be level 4. So let us now look at the relationship between Companies Act and the accounting standards. So till 2006 there was only one set of accounting standards, and the Companies Act basically said follow the standards issued by ICAI. So ICAI issued the first accounting standard, AS1, in 1979 and was issuing the other standards as various points in time. So till 2006 there was no two set of standards, there was only one set of accounting standards. The Companies Act just said follow whatever ICAI has issued. In 2006 what happened was, specifically 7th December 2006, the central government through the Ministry of Corporate Affairs notified the Companies Accounting Standard Rules 2006. Under these rules, accounting standard 1, 2, 3 and so on were notified. Okay. The full text of the standards were notified in the rules. So essentially the position changed from follow what ICAI has issued to follow what we are issuing. Okay. Essentially it was the same. Whatever was issued by ICAI, slightly modified and issued as Companies Accounting Standard Rules 2006. What were the nature of modifications? For example, there were interpretations separately issued by ICI. These were incorporated in the main text of the standard as explanations. Okay, essentially it was the same. So these 2006 Companies Accounting Standard Rules were replaced by the 2021 rules. There was a change in the classification of, or other change in the criteria for classification as SMC or non-SMC. That was what happened in 2021. So now essentially we have two sets of standards issued by ICAI that applies to non-corporates and notified under the Companies Act that is applicable for corporates. So let us now study what is the criteria to be classified as SMC and non-SMC. So it's very simple. Small and medium company criteria is the reverse of level 1 entity criteria. So what is level 1? So it should either be a listed company, or it should be a bank or a financial institution or insurance entity, or turnover greater than 250, borrowing greater than 50, holding a subsidiary of any of the four. So if I want an opposite of this, then I will say not listed and not a bank. Because if any of these criteria are satisfied, it is level 1. I don't want any of these criteria to be satisfied. That is, all the criteria should be violated, you could say. So it should not be listed, it should not be a bank, turnover should not be more than 250, borrowing not more than 50, not a holding a subsidiary of any of the above. So that is the definition of SMC. Okay. So everything will have not, and instead of or there will be and. Okay. So let's now look at the criteria for SMC. Equity debt security is not listed and not a bank or financial institution or insurance entity, and turnover not greater than 250 crore, borrowing not greater than 50 crore, not a holding or subsidiary of any of this. Okay. So that means not a holding or subsidiary of non-SMC. And what is a non-SMC? It is simply not an SMC. So small and medium company is what? Is not level 1. Okay. So in short we can say SMC is level 2, 3 and 4. What is non-SMC? It is not an SMC. Okay. So that means it is not 2, 3 and 4, that means it is level 1, right. So all we have to do is remember the level 1 criteria, and using that we can easily remember the criteria for level 2, 3, 4. For level 2 and 3, just remove the first two, listed, bank, remove those two, turnover and borrowing criteria, go on dividing by 5. That will give you the criteria for level 2 and 3. Level 4 is what? Neither 1 nor 2 nor 3. SMC, how do you remember? From level 1 criteria you make everything negative and you add the word and. Okay. What is non-SMC? Not an SMC, right. Only point to be remembered is not a holding or subsidiary of non-SMC. You should not write here SMC. Okay. Not a holding subsidiary of any of the above. If any of the above is satisfied, it is not an SMC. So not a holding or subsidiary of non-SMC, right. So this is how we classify under the Companies Accounting Standard Rules 2021. In 2006, the only difference was in the turnover and borrowing criteria. It was different, it was much lower. Now that has been increased, right. So let's now have a quick comparison between the accounting standards applicable to non-corporates and corporates. So for non-corporates, the accounting standards issued by ICAI are applicable, and for corporates, the accounting standards notified under the Companies Accounting Standard Rules 2021. Please remember that both these accounting standards are essentially the same. So in 2006, when companies accounting standard rules 2006 were notified, essentially what happened was the standards issued by ICI were slightly modified and notified under the Companies Act, later replaced by Companies Accounting Standard Rules 2021, right? So it's essentially the same. But because they were issued at different points in time, the way they were issued and later some standards were withdrawn, there is a difference. We will see that shortly. So accounting standards issued by ICA should be followed for non-corporates, notified under the Companies Act for corporates. So classification for non-corporates, it is into 4 categories, level 1, 2, 3 and 4. And for corporates, it's only 2, SMC and non-SMC. So now, a new fact which we have not seen before. How many accounting standards were originally issued? So ICAI started issuing accounting standards from 1977. So when we look at 2006, okay, ICAI had already issued some standards and had withdrawn a standard. Post 2006 also some standards were withdrawn. But from the first standard 1977 till today, how many standards were issued in total? Okay, that is what we are asking. That number is 32. From the first standard till today, 32 were issued by ICAI. Of this 32, not all are effective, some were withdrawn, okay, at various points in time. Similarly for corporates, now for non-corporates we are talking of 1977, but for corporates we are talking of 2006 till date, okay. So in 2006, some standards were already withdrawn by ICAI, so those standards were not notified under the Companies Act. And post 2006, some standards were issued by ICAI that were not notified, okay. So from 2006 till today, only 28 standards were issued in total, or rather notified in total under the Companies Act. Of this, one was withdrawn, okay. So what were they? So that's what we're going to see next. So the accounting standards withdrawn by ICAI, remember from 1977 till today, it has issued 32 in all. So this AS 8 was the first to be withdrawn. It was withdrawn in 2004. Now you need not remember these facts, it is just for understanding, okay. So when were the accounting standards first notified under the Companies Act? 2006. In 2004 itself, this AS 8 was withdrawn. It was merged with AS 26, okay. So just remember, this was not there in 2006. So never notified. 30, 31, 32 were issued by ICAI post 2007. Again not notified, okay. So these 4, that is the difference between the 32 and the 28, right. So 32 issued, AS 8 first to be withdrawn, 2004, AS 30, 31, 32 were issued only in 2007, later withdrawn. So corporates only 28 issued, that is excluding these 4. AS 6 was the last to be withdrawn. It was withdrawn in 2017, okay. Both places it was withdrawn. So now today, how many accounting standards are applicable to non-corporates? If you had to ask that question, the answer is 27, okay. 32 issued from 1977 till today, of which all these withdrawn at various points in time, we have only 27. For corporates, notified itself was only 28, that is excluding these 4, okay. 6 withdrawn, because AS 6 depreciation accounting was merged with AS 10, okay, in both places. So here also you have only 27. So today, in both for non-corporates and corporates, we have only 27 effective accounting standards, okay. So let's now look at a list of the 27 effective accounting standards. You may pause the video here and go through this list. So, hope you have gone through the list. Now, let us look at the entity-wise applicability of accounting standards. So, what do we mean by this? All 27 effective accounting standards are not applicable to all the entities. The bigger entities, that is the entities at the top of the classification ladder, that is level 1 in the case of non-corporates and non-SMCs in the case of corporates. So, these entities at the top, they have to follow all the accounting standards, right? So, all accounting standards should be followed by level 1 entities and non-SMCs. So, the entities below, that is levels 2, 3, 4 in the case of non-corporates and SMCs in the case of corporates, they need not follow all the standards. Some standards are totally exempt, they need not follow them at all. We call them as exemption, and some standards are applicable, but some relaxations are available, right? So, on the next slide, we are looking at the accounting standards that all non-corporates should follow, including the micro, small and medium enterprises, that is levels 2, 3 and 4. Level 1 anyway should follow all 27. This list is also applicable to levels 2, 3 and 4. Okay. There are only some disclosure exemptions, okay, in certain accounting standards. Some paragraph wise exemptions are available in AS 15. Also, provisions relating to deferred tax are not applicable for level 4. Okay. So, you can just pause the video here and go through this list. So, DE means disclosure exemption and E means an exemption in the provision. So, provisional exemptions are there in AS 15 for all MSMEs, in AS 22 only for level 4, and in the others there are some disclosure exemptions. Okay. So, you can just pause the video, go through this. Next is a list of accounting standards that are applicable only for some MSMEs. Even within the levels 2, 3 and 4, there are some exemptions. So, the difference between this slide and this slide is, in the first slide, all these standards are applicable to all, only some disclosure exemptions are there, partial exemptions are there. But in this slide, there are 100% exemption, entire standard is exempt. In the case of AS 3, entire standard is not applicable for levels 2, 3, 4. AS 14, entire standard does not apply to level 4, applies only to levels 2 and 3. AS 17, entire standard not applicable for levels 2, 3, 4. Similarly, 20, 21, 23, 24, 25 and 27. All these standards 100% exemption, that is the entire standard is not applicable. Here and there it is applicable, that is AS 14 for 2 and 3, AS 18 for level 2, AS 28 for 2 and 3, and even this AS 28 there are some disclosure exemptions. Okay. So, it is easy to remember. The first slide, all levels should follow. Here and there are some disclosure exemptions. Some provisional exemptions are there in 15 and in 22. In this slide, this list, mostly they are not applicable. Here and there they are applicable to levels 2 and 3, that is AS 14, AS 28 and AS 18, applicable only to level 2. So, you can pause the video here and go through both these lists. So, for companies it is much easier to remember. We have one list which applies to both non-SMCs and SMCs, and we have another list where the two accounting standards are completely exempt, 17 and 25, and these other standards partial exemptions, that is some paragraphs are not applicable. So you just remember this list for companies, these are not applicable for SMCs. You remember this and you subtract this from the list of the 27 effective accounting standards. Okay, so this contains all the 27. From this you just need to remember for SMCs all these are not applicable either in full or partly, and then you get the balance, right? So for companies it's quite easy to remember. So you can pause the video here and go through these two lists. Please note that all the standards are applicable to non-SMCs, all 27, and all 27 are applicable to level 1 also. Next, now what we are going to see is, suppose there is an exemption, AS 17 is exempt, but still I want to follow AS 17, okay, then what should I do? Or AS 15, there are multiple provisional exemptions, say there are 4 exemptions. Out of those 4, I want to take advantage of 2 exemptions, other 2 I don't want to take advantage of that, I want to follow those principles. Then what should we do? Suppose we were a level 1 enterprise in the current year. Next year we are no longer level 1 enterprise, that is we go down. Or this year we are a level 4 enterprise. Okay, last year we were a level 3 enterprise, so we are coming down. Or we are going up. This year we are level 4, next year we become level 3. So all these different situations are possible. So then how do you apply? Okay, that's what we are going to see here. So if an MSME, that is level 2, 3 or 4 or SMC, opts to avail all the exemptions and relaxations, whatever exemptions and relaxations are available, it is opting to take advantage of them. Then what should be disclosed? The fact that it is an MSME or the fact that it is an SMC, that should be disclosed, and the fact that it has complied with the applicable AS. So it has to be an explicit statement in the notes to accounts. Now, if only certain standards we want to take advantage of the exemptions, other standards we want to follow. For example, an SMC need not follow AS 17 or AS 25. Many exemptions are available within these standards. Suppose an SMC chooses to follow AS 17, takes advantage of the exemption for AS 25. Okay, so standard wise it is choosing. One standard not applicable but it follows, another standard not applicable doesn't follow, takes advantage of the exemption. Then it should disclose the standards in respect of which it has availed the exemption. So AS 17 is exempt for SMCs, but it is following AS 17. AS 25 exempt, not following. So it should say we have availed the exemption in respect of AS 25. Okay. If you are availing all AS 17, AS 25 and all the other exemptions, if you are availing, you need not make this statement. All you have to do is you have to state that you are an MSME or an SMC, that you have complied with the applicable AS. So this statement should anyway be given. Okay. So in respect of AS 25, if you are availed the exemption, this statement you have to say anyway. If you follow all the 27 accounting standards, then you need not state this. But if you are availing of the exemptions, this statement has to be made. Okay. Additionally, if there are some standards in respect of which you have not availed the exemption, you have to make another explicit statement. Fine. Now, another case, what if within the standard we are choosing? Here standard wise we are choosing, that is this case, AS17 we are following, AS25 we are not following. Here within the standard we are choosing, say in AS15 there are 4 exemptions, we are taking advantage only of 2 exemptions, that is also allowed. Okay. But an additional responsibility is cast on the management and the auditors that it should not mislead any person or public. So, standard wise if you take advantage of exemptions, that is allowed, you make this disclosure. Within the standard if you choose additional responsibility, make sure it does not mislead any person or public, right. Similar principle applies to disclosures made when it is not required. So, that has to be as per the applicable layers. So, just because there is a disclosure exemption and you choose to make the disclosure, it does not mean you can do it whichever way you want. Okay. If you are disclosing, follow the procedure. Though it is not required, follow the procedure if you are choosing to make the disclosure. Okay. Next, say if you move higher from level 2, you become level 1. Last year you were level 2, this year you become level 1 and so on. Level 3 to 2 or 4 to 3 or 2 or 4 to 1, or from SMC you become non-SMC. Does it mean you have to restate the previous year figures? Because when you move higher, more accounting standards become applicable, you have to follow those accounting standards. Does it mean you have to change the values for the previous year? No. So, the point is, we will apply the relevant standards only from the current year, we will not change the comparatives, we will not restate them. Okay. What if you move lower? Last year you were level 1, this year you come down to level 2, or last year level 2, this year you have come down to level 3 or to level 4. Last year non-SMC, this year you have come down to SMC. You cannot immediately take advantage of the exemptions. Okay. So, last year when you were non-SMC, all 27 standards you would have had to follow. This year you become SMC, many exemptions are available, but still you can't take advantage. This year you have to follow all 27. Next year also if you continue to remain SMC, then you can take advantage of the exemption. So, you have to remain in the lower level for 2 consecutive accounting periods to avail of the exemptions or relaxations. So, let us now proceed to the next section, that is accounting standards in the context of the Income Tax Act. So, we know there are 27 effective accounting standards. Should you follow them when you prepare your return of total income? Okay. In some cases, yes. Suppose section 115 JB is applicable, the book profits are calculated using these 27 accounting standards. Okay. Or in the case of SMC, whatever standards are applicable. Now, as per section 145, we all know that for profits and gains from business or profession or from other sources, you can follow either cash or mercantile basis of accounting, that is as per section 145. If you follow mercantile basis, then as per the Income Tax Act, income computation and disclosure standards should be followed. So, remember this is only for profits and gains from business or profession and for other sources. This will not apply to the other heads of income, right. So, this is a list of the income computation and disclosure standards. You may pause the video if you wish here and go through this list. So we have covered till here accounting standards issued by ICAI, accounting standards notified under the company's accounting standard rules 2021, and also accounting standards under the Income Tax Act. In the next video, we will cover IFRS and Ind AS. So till we meet again, namaste.